Let's talk about C Corporation taxes. So here is a full guide into C Corporation taxes. Here's an overview I want you to pay attention to. So when we talk about C Corporation taxes, we're talking about, first of all, let's talk about C Corporation tax rates. So the current tax rates for C Corporations is a flat 21%. So this happens under the TCJA. So we're talking about 2018. So since then, we have a flat 21%. And so when are C Corporation tax returns due? Well, tax returns for calendar year C Corporations are due April 15th or around that time. And the C Corporations must also file estimated tax payments if required. First quarter payments are due April 15th or April 15th or somewhere around that period. Second quarter payments are due around June 15th. Third quarter payments are due September 15th, and fourth quarter payments are due December 15th. And a C Corporation with a fiscal year must generally file its tax return by the 15th day of the fourth month after the end of its tax year. So the one exception to this rule is for a C Corporation that has a fiscal year ending June 30th, whose due date is the 15th day of the third month after the end of its tax year. In other words, September 15th. So how are C Corporations really taxed? So when we talk about C Corporation taxes, you have to understand that a C Corporation files its tax return on Form 1120. Don't confuse this form with Form 1120S, which S Corporation used to file tax returns. Okay, shareholders can receive money from the corporation in the form of a wages or salary, for which they would receive a Form W-2, or dividends reported on Form 1099 Div. But a C Corporation shareholders does not report an allocated amount of revenue and expenses as an S Corporation shareholder does. And this section discusses filing a C Corporation tax return. I'll talk about that later on in the next session. But you always want to make sure that before you actually file a Form 1120, that you basically have all your Form 1099 Div, for instance, and also your Form W-2. Very important. Welcome back, boss, to this show. Really appreciate having you here. Make yourself comfortable. You are going to enjoy today's conversation. So here are the steps I want you to really follow. How do you fill out Form 1120? Okay. First of all, you want to keep your accounting records and financial statements up to date. An accurate balance sheet and income statement helps to make preparing your C Corporation tax return extremely easy every year and will ensure that you do not run the risk of reporting too much or too little income, right? That you don't want that. If your business grows big enough, you will be required to report your balance sheet on Schedule L of your C Corporation's tax return. So you want to also record your income. So the first section of Form 1120 is where your business's income and cost of goods sold are recorded. And you want to record also your expenses. So the second section of Form 1120 is where your business's expenses are recorded. Then you want to calculate your net profit or losses. So you want to subtract your total expenses from your gross income to compute your net profit or loss. And what happens here is that on a C Corporation tax return, the technical name for your business's profit or loss is taxable income or loss. And then you want to calculate taxes owed and payments made. So you want to calculate your C Corporation's tax liability according to the Form 1120 instructions. Also, you want to record any payments made during the tax year along with any tax credits. And then you need to determine balance owed or overpayment. So the final dollar amount on page 1 of your Form 1120 will tell you whether you actually owe or not, and either how much money you still owe the U.S. Treasury or how much money you overpaid to the U.S. Treasury. Then you need to complete Schedule C. So this schedule calculates any dividends that will be distributed to shareholders along with various special deductions. Then Schedule J. So this schedule is where you will compute the tax liability of your C Corporation. Then you have to complete Schedule K. So this schedule contains miscellaneous questions and information about your C Corporation. And then complete Schedule L. If required, complete this schedule. This is where you will report your business's balance sheet. And then here you have to complete Schedule M1. This is where you reconcile taxable versus non-taxable income and deductible versus non-deductible expenses, and also complete Schedule M2. So this is a more detailed look at the C Corporation's return earnings. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about C Corporation taxes. This is a full guide. Now, let me give you an approach you need to really follow if you're trying to really file your taxes for C Corporation. Now, it's really important to understand that when we talk about a C Corporation, what is it really? Well, a C Corporation gets its name from the section of IRS Code, subchapter C, that regulates it. So until the event of S Corporation in the 1950s, the C Corporations were the only unincorporated business structure. And to this day, people refer to them simply as corporations. So a corporation is a legal charter granted by a state to investors who want to gather private funds for a specific purpose. So this is kind of cool. And so the cool thing is that you have the ability to gather fundraising ability through a C Corporation. Now, how is a C Corporation structured? Now, regardless of whether the C Corporation is small or large, it will have the top-down approach, the same top-down approach. And in small companies, for instance, one person may need to play several of the roles that I'm going to share with you right now. But if you have a large entity, you will have different people. So you will have a board of directors, you will have officers, you have shareholders, you have employees. Okay. And so how does the C Corporation differ from other business and corporate structures? Now, the C Corporation's main feature is its unlimited growth potential. Unlike the S Corporation, which can have no more than 100 shareholders, must restrict its business to the United States, and can only issue common stock, the C Corporation has none of those restrictions. An owner does not need to be an American citizen, nor does the corporation need to operate in the United States. There can be unlimited shareholders. And moreover, C Corporations are attracted to investors because they can issue any class of stock. And the C Corporation is the only business structure that is taxed as its own entity. That is, it must file its own taxes through a designated tax form that I just spoke to you about earlier, right? Form 1120. And C Corporations also have their own tax rates. That's like 21%. So basically, there was the Tax Cuts and Jobs Act of 2017. I said 18 before, but it is 17. So this is what it is. So the current rate is 21%. So what are the advantages of becoming a C Corporation? I mean, basically, a lot of folks talk about the double taxation of a C Corporation, but there are a lot of advantages, okay? Owners have limited liability. The C Corporation has perpetual existence independent of its owners. Corporate ownership is fluid. It's very easy to attract investors. Unincorporated businesses garner more respect. And there are tax-deductible business expenses. So those are the advantages. Let's quickly go into the details here. So when we talk about limited liability, a C Corporation is a separate legal entity, and the liabilities of the company are separate from shareholders' personal assets. So liability is limited because shareholders may have used personal assets as collateral on a business loan. The assets may be liable depending on the extent the individual has invested in the company. But in most cases, personal assets cannot be touched. And the C Corporation has perpetual existence independent of its owners. So unlike general partners and sole proprietorships, where the business ends with the life of the proprietors, C Corporations live on in perpetuity unless the shareholders vote to dissolve the company. And corporate ownership is really fluid, and this is kind of cool because to own a corporation, you must have a controlling interest in the company's stock. Another way of putting this is to say that the shareholders with the most stock own the company. Most individual investors in a publicly traded company own just a tiny fraction of the company. However, those central to the business own larger percentages and generally seek to maintain controlling interest. It is possible, however, for individuals to buy the controlling interest in a company's stock against the will of the directors, resulting in a hostile takeover. So what about the disadvantages of becoming a C corporation? Well, shareholders experience double taxation on stock dividends, right? There are a lot of rules and formalities, and there is no deduction for corporate losses. So this is kind of important. So with a C corporation, shareholders lose the ability to deduct corporate losses the way they can in an S corporation, allowing them to lessen the overall tax burden. That's because the C corporation is taxed as a separate entity. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about C corporation taxes. This is a full guide. Now let's talk about registering your business as a C corporation. Okay. Now the thing here is that there are a few steps you need to take. Nothing complicated. You can do it yourself, or you can just hire a third party to sort of help you out, to help you form a C corporation. So you want to choose a legal name for the company. You want to reserve the name, that business name, with the Secretary of State if possible. You want to draft the articles of incorporation with the Secretary of State. You want to actually identify the initial shareholders and issue stock certificates to them. You want to apply for any pertinent business licenses. You need to actually get an employer identification number, so EIN. So the EIN is kind of critical because this is how you're going to actually direct your tax-paying responsibilities. You want to funnel the tax-paying responsibilities. So your EIN that the IRS gives you can also be used at the state level, not a problem. And finally, you want to apply for ID numbers required by the local and state government agencies, including the tax agencies, because it's one of those things where you have to, like, for example, your C corporation will need tax ID numbers for each employee account, in addition to establishing its own EIN. And it's one of those things where you have to always comply. Otherwise, all states are pretty strict when it comes to that. Okay. And when we talk about your the tax implication of a C corporation, you need to understand that as a shareholder, you do not have, like, you're taxed twice, that's for sure, but you're not actually involved in the day-to-day operations of the business. You're not, you're paying taxes when you actually get your dividends. Let's say your Form 1099 DIV. That's when you pay taxes at the I would say at the individual level, when you file your Form 1040 Schedule C. Let me give you a bonus here. So basically, when we talk about a C corporation, there are some tax benefits, like concrete tax benefits of C corporations. A lot of folks, once again, just want to dwell on the double taxation sort of C corporations, but there are a lot of tax benefits. Number one, you can minimize your overall tax burden. Okay, basically, we, as mentioned a little earlier, we went from 35% to 21% when it comes to the tax rate. After the TCJA implementation in 2017, and so that's really good. So minimizing your overall tax burden. You can carry profits and losses forward and backward. So whereas the fiscal year must coincide with the calendar year for LLCs and S corporations, C Corps enjoy more flexibility in determining their fiscal year. Therefore, shareholders can shift income more easily, deciding what year to pay taxes on, bonuses, and when to take losses, which can substantially reduce tax bills. What about collecting funds for future expansion at a lower tax cost? That's another benefit here. The C corporation model allows shareholders to shift income readily and retain earnings within the company for future growth, usually at a lower cost than for pass-through entities. So since profits from S corporations appears on shareholders' tax return, whether they have taken a distribution or not, owners can get bumped into higher tax brackets, even though they plow profits back into the company. Also, writing off salaries and bonuses. So shareholders of C corporations can serve as salaried employees, while these salaries and bonuses fall subject to payroll taxes and Social Security and Medicare contributions. The corporation can fully deduct its share of payroll taxes. This is really good. Moreover, the company can pay employees enough so that no taxable profits remain at the end of the fiscal year, within reason, of course. The IRS does check that the salaries correspond to the services that shareholders provide as employees. And shareholders frequently use this option instead of receiving dividends, which would indeed be taxed twice. Also, deducting 100% of medical premiums and other fringe benefits is also really kind of interesting. You also have writing off charitable contributions. You're able to carry losses over multiple years. This is really cool. You can enjoy fewer ownership restrictions than S corporations. And a C corporation really encourages passive investors. And a C corporation also opens unique financing opportunities in terms of drawing cash, for example, from financial markets, but also from foreign investors. Let me give you a few pro tips before closing today's conversation here. It's really important to understand that when you talk about C corporation taxes, C corporations are not the only business structure, right? You got to really, C corporations require a lot of formalities, a lot of bureaucracy, and a lot of investors, especially entrepreneurs, solopreneurs, love to have the flexibility of an LLC or the flexibility of a partnership. So it's one of those things where you got to really ask yourself what's really good for you. At the end of the day, you got to really choose a tax benefits that I would say a tax structure that works for you. Remember that when we talk about S corporation, basically you do not have an S corporation as a legal entity at the state level. You first need to actually be a corporation, and then you can elect S corporation status. If you're an LLC, you can also elect S corporation status. Same thing if you're a C corporation. Okay. Now most states actually tolerate they tolerate, in quotes, of course, they tolerate the S corporation tax status. But it's one of those things where you have to actually check with your state tax authorities to make sure that they have it in your state. So when we actually sort of close C corporation taxes, remember that it's all about if you want to have, I've spoken to you about the pros and cons of C corporations, and also the fact that if you have more flexibility on certain things and you have less flexibility on other things. At the end of the day, you have to make a decision as to what really works for you. What really works for John may be different from what works for Jane and for Mike and others. So it's one of those things where you want to really, again, look at your situation and see what really works for you. And this is how you make your decision. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about the C Corporation Taxes Full Guide, and I give you the overview, the steps, the approach, and I also talk to you about the bonus and the pro tips. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.